I was an unprofitable trader until I found this one trading tip, and trust me, it saved my trading career. Many don't even know it because it's always been hidden in plain sight right within the candlesticks. Let's take a look. If you are trading, you cannot escape from the fact that what you need to succeed, to be a long-term, consistent, profitable trader, lies within the candlesticks themselves, right? So I'm going to teach you the 3 types right here today so you don't ever get lost and get caught trading when you shouldn't be trading in the first place. So here we have the first type of candlestick, which is what we call an expansive candlestick in one direction, either higher or lower. So on the left, we have a bullish candlestick, which is in white. And on the right, you have a bearish candlestick, which is in black. So this is typically the candlestick that you want to have the bulk of your trades in, meaning that after you enter a buy or a sell, you want to ideally see this type of candlesticks on the higher time frame relative to your low time frame trade. So what that means is because this candlestick right here, let's say it's a daily candlestick, right? It's a higher time frame candlestick. And let's say you enter on the 1 hour. What that will look like on a line chart is you have an open, a low, it forms that high, passes past that opening price, and then comes down to form that closing price. Okay? The same thing goes for a bearish candlestick. You have the opening price, it comes up, forms that high, pushes down lower, forms that low, and then closes right before that low price. So with this in mind, you are looking for your trades within these candlesticks right here. And what that might look like on a low time frame chart is if I go to the right hand side right here, I will see that this is a very obvious day where it is a bullish candlestick, right? Assuming this is a daily time frame. So with this in mind, this is that daily candlestick and this is that H1, for example. Okay, so we are going to be seeing price open right here for the day. It trades beneath that opening price and then expands through it, and then it just trades higher and higher and then forms that high, pulls back, forms that closing price. This is where the daily candlestick has finished forming. So with this, you want to have your trades taken somewhere ideally near to the opening price as much as possible before we expand higher for that day. So this is a bullish example. A bearish example is right here. We have that opening price and then we form that high, push down beneath the opening price, and then we now expand lower, forming that low price and then closing right here. So regardless of what time frame alignment you're using, right? Daily, H1, weekly, H4, or whatever other format that you may have, as long as you're opening close to the opening price of an obvious bullish or bearish day, you're going to be entering at a good price, assuming it is a expansive candle and you have your bias correct. Okay, so that is the first type of the candlesticks. The second type right here is what I would like to call a reversal candle. Now, typically, this kind of candles happen right when we are about to reverse from a key level or do a trend continuation, assuming some form of reversal has already happened. So this typically happens beneath the point of reversal. So let's say you're expecting a bullish trend to happen from this key level. Typically at the bottom of that trend, you are going to be seeing a candlestick that looks similar to this reversal candlestick right here. And the reversal candlestick will mainly have this key difference from the expansive candlestick, where let's say it's a bullish candlestick that's going to be a reversal candlestick. The lower wick is going to be a lot larger in ratio compared to the upper wick, and sometimes even compared to the candlestick body, right? So that is when the large wick will be in the area of the rejection. So for bearish candlestick, let's say it hits a weekly or daily key level or whatever key level that you have, this is likely going to be the candlestick that appears right at the high or the highest point before that bearish drop. So whenever you see a reversal candlestick, you have to always be prepared to have an expansive candlestick following right after this candlestick right here. So what a reversal candlestick might look like on the lower time frames right here, let's say this is a weekly, this is a 4-hour, right? For example, we're gonna see the opening price once again. Price is gonna have a sharp turn lower, forming that low of that candlestick, and then pushing above the opening price, forming that high, and then we pull back and then we close somewhere around here. So this is what a typical reversal candle look like. And yes, sometimes a reversal candle can also be quite expensive, as we see in this example right here. The main point to note is just that the lower wick is going to be a lot larger than the upper wick. That's the key difference that we are going to be seeing between these two types of candlesticks, right? So moving on to a bearish example, we have the open, right? Price comes up from set high, comes back down from set low, and then we close right around after pulling back from that low of the higher time frame candlestick. Yes, sometimes it won't be that obvious. It may chop around by a bit, but this V shape right here is what you want to see when you are trading within a reversal candle. That you can trade both a reversal candle as well as an expensive candle. They both do work. Now, the next candlestick is a candlestick that you don't want to be trading in. Say you are a day trader, you don't want to be trading within this indecision or indecisive candlestick right here. Because if, let's say this is the daily, and then this candlestick just printed, you don't have a bias because the candlestick is not showing you much information. Because what it did was it opened right here, traded lower, traded higher, and then pushed back very close to the opening price of that higher time frame candlestick, right? Vice versa for a bearish candlestick, we open from the high, low, and then we closed very near to the opening price. Now, this candlestick, when you translate it over to a lower time frame chart, typically looks like this, which is very, very ugly in my opinion. This is the worst type of higher time frame candlestick to be trading within, because it is just a big range on a lower time frame and it is not ideal, right? There's no clear direction, higher or lower, that it is likely to be trading into. It's not giving you any clues, right? This is a bullish example and this is a bearish example, where in both examples, we really just chop around the opening price, forming quite equal highs and equal lows, and then we ending up closing very near to the opening price of the candlestick, right? So it is best to avoid trading after this type of candlestick has formed, because you are likely going to be trading within a chop, and it is always best to trade right after we break out of this range and sustain of, you know, either above or below that range. Okay, so going to an example right here, let's say this is the daily time frame, right? We are clearly in a range, so this means that the weekly candlestick is pretty much also a range, right? But let's say you have a bias, you have a narrative, and you are sticking to it, and let's say the narrative is for a bullish bias, right? So you would be looking to trade after we take out some kind of key level, and let's say you trade liquidity. So right here we have a previous week's low, which we are using to target to frame a reversal trade off of. So we want the price to open, come back lower, and then tag that previous week's low before, you know, we get in line with that long. So moving next to the charts right here, this is, let's say, the 1 hour chart. So we know we are bullish on the daily. We want price to come back and then tag this previous week's low, which we have done now. And then once we have tagged this, we are also beneath that daily opening price of this candlestick right here. We are now looking for a potential reversal higher. And zooming in, you can also see how at the bottom of this low, we are showing what? Well, we are showing a 1 hour bullish reversal candle, right? With this really large wick compared to the upper top wick right here. So moving left, you can see that what follows next is a very clean, expansive candle reversing from this key level and also showing you that on the lower time frames, we are potentially seeing signs of reversals early on into the trading day or the trading week. So this is that reversal candle, and this is the expansive candle that we went through just now. So yep, thank you all for watching. With this knowledge in mind, you can now navigate the markets purely based off of candlesticks without even needing to touch the strategies that other people are using or you are using. This is a very good confluence regardless of what time frame you're trading on and what approach you are using. Found value in that video? Guess what? It's just a preview of our upcoming 2-day live intensive webinar where we bring you through different modules suitable for all traders of all levels. Regardless if you are a beginner or intermediate trader, we have modules prepared for you to put you on track to get your trading success right in the palm of your hands. So don't wait any longer. We only have 300 seats, and currently we are running an early bird promotion where the first 50 people to use the code RRB90 get 90% off of the full tuition of the webinar. I'll see you there. Let's break the rat race together.